The world is ending and society as we know it is over. Okay, no. But it is the end for some small independent banks. How does this happen though? How are these big institutions that hold all of our money just collapsing? And what happens to everyone's money? Well, you may be surprised to know that this isn't a new concept. Banks have collapsed quite a few times throughout history, perhaps the most famous time being the Great Financial Crisis. To understand how this happens, we first need to have a very basic understanding of how banks work. Don't worry, I'll dumb it down as much as possible though. Banks primarily make money through the interest rates on loans. When you give your money to the bank to hold, they don't keep it there locked away in a vault like in Harry Potter. No, they use it to give other people loans. But wait, why are they using my money? Well, banks run on a unique system called fractional reserve banking, which means only a fraction of deposits, typically around 10%, need to be held in cash, while the rest they can use to loan out. This percentage is set by the Federal Reserve and is like a safety net for when customers want to withdraw cash from their accounts. Ah, yes, I can see the cogs turning in your brain, working out how banks collapse. Banks collapse because of something called a bank run. A bank run, or a run on the bank, is when too many clients withdraw their money from a bank because they fear their money isn't safe. And while if all the clients of a bank try and withdraw their money, the bank goes bankrupt because they do not physically have everyone's money because Edward's out there strutting around the streets with it in his new loan. Banks only work because everyone is only using a small percentage of their money at the same time. So to put it simply, banks collapse because too many people try to withdraw their money at the same time and the bank can't sustain it because they don't physically have all the money, forcing them into bankruptcy. But these sort of things just don't happen out of nowhere, and bank runs feed on fear. So where does this fear come from? How do they start? Well, the fear is fear of the bank collapsing. And let's look at what has just happened to cause the collapse of the Silicon Valley Bank to explain an example. As well as using your money to give out loans, banks also invest it usually in really safe things like US Treasuries, which is great, but not in this case. You see, back in 2021, Silicon Valley Bank invested nearly $100 billion in government-backed bonds. And this is probably starting to sound like a bunch of jargon to you, so let's just say that Silicon Valley Bank placed a $100 billion bet that interest rates wouldn't rise very fast. Spoiler alert, they did. You see, bonds have a yield time, and if they're held to maturity, let's say 4 years, they make a percentage of interest. However, if the interest rates rise over that time and the bond is sold before maturity, it is sold at a loss. So once again, Silicon Valley Bank bought $100 billion worth of bonds with a 3 to 4 year duration. Right after they bought them, interest rates rose dramatically, putting them in a very high-risk situation because if they have to sell the bonds before maturity, they can potentially lose billions of dollars. But hey, that's only if they have to sell them, right? Surely they'll be able to hold out till the end of the bond contract. Wrong. Silicon Valley Bank's primary customers were tech startups, and the world of funding for them is not going so great at the moment, which means they had to keep withdrawing money from their own bank accounts to fund the startup costs. Now this is where the dominoes begin to fall. To account for all the withdrawals, the bank had to sell a portion of their bonds at a $1.8 billion loss. Now to account for this loss, they announced that they're selling a third of the ownership of their company to raise capital. This is right around when the word started getting around that the company could potentially be facing insolvency issues. And as a result, their stock price plummeted more than 60%, meaning they wouldn't even be able to raise enough capital. This is when the panic set in. Startup founders were being advised to pull their money as fast as possible. And so the bank run began, leading to the collapse of the Silicon Valley Bank. But what happens to the client's money? Do they get it back? Yes and no. After the banking crisis during the Great Depression, the Federal Deposit Insurance Company was created to get people to trust banks again. Banking clients are protected by the FDIC, who will pay back money up to $250,000, which is really great, unless you have more than $250,000 in your bank account. And while out of the clients of Silicon Valley Bank, who were primarily tech startups, 97.3% of them aren't FDIC insured because they had a greater amount of money. In cases like this, typically losses are recovered in bankruptcy court when assets are sold off. But this can take several years, and more than likely the customers are not going to receive all their money back. So should you withdraw all your money and stuff it in your mattress? Probably not. Silicon Valley Bank was caught at the center of a disaster storm, with the industry of their primary clients requiring them to withdraw heaps of money, a large proportion of their money locked away in bonds, and rising interest rates. There is always a level of risk. But large banks have a very small chance of collapsing, and the average person is protected by the FDIC. All I know is that I'll be really upset if I lose the $43 in my account.